Good morning, everyone. You are very welcome to this morning's webinar from Chartered Accountants Ireland. My name is Susan Rosney, and today it is my privilege to partner with Climate Finance Week Ireland 2022, an essential week in the calendar of sustainability and finance. Chartered Accountants Ireland is identified as a responsible stakeholder in the Government of Ireland's Ireland for Finance Action Plan, in the section Enhancing the Development of Talent and Diversity in its support of the financial services sector. Since the Ireland for Finance plan was published, Chartered Accountants Ireland has launched its Certificate in Sustainability Strategy, Risk and Reporting, on which we have partnered with Sustainability Works. And we have integrated sustainability across our entire CPD programme, in addition to growing the numbers of students taking the flexible route to chartered accountancy within the financial services sector. I'm delighted to be joined today by two expert speakers with knowledge of both the accounting and legal perspectives of the legislation, its interrelation with the EU Taxonomy Regulation, and the differences between the Article 8 and Article 9 funds. Laura Houston is the co-founder of Sustainability Works, a boutique sustainability consulting firm that offers a unique blend of experience and skills across sustainability strategy, finance, policy, and communications. A fellow of the Institute of Chartered Accountants Ireland and a chartered tax advisor, Laura has over 20 years professional experience across industry and practice. While working with KPMG and Airtricity, Laura specialised in working with corporates and asset managers in the renewable energy and energy efficiency finance sectors. She now lectures on sustainable finance, and her consulting work covers a broad range of sustainable finance topics. Anne Shields has worked in the Irish funds and regulated financial services industry for over 20 years, mainly as a qualified solicitor. She now runs her own sustainable finance regulatory consultancy, Finlexis, working with regulated fund management companies and international asset managers to understand and implement EU sustainable finance regulatory requirements. Anne holds a certificate in sustainable finance from the University of Cambridge's Institute for Sustainability Leadership, and she is a Green Team Network Steering Committee member and lectures in responsible and sustainable finance at the Institute of Bankers in Ireland. In this short webinar today, we will begin with Laura giving the background to the Sustainable Finance Disclosure Regulation and situating it in the broader ESG landscape. Laura will be followed by Anne, who will provide the legal perspective on the regulation and more detail on Article 8 and Article 9 funds. I will join you again at the Q&A, and please note that you can ask questions using the Q&A feature, and that a recording of this webinar will be available via the Climate Finance Week Ireland website and in the resources section of the Sustainability Hub of Chartered Accountants Ireland. I will now hand over to you, Laura.
Brilliant, thanks, Susan. And I think Susan has nearly gone through our agenda for today. So just a reminder here about what we're going to be talking about today. I guess I'm the first bit. I tend to always be the first bit. I'm like the definition section, but we're going to be talking about that, looking at different ESG investing approaches. Then we'll give an overview on the SFDR and some commentary around that from a legal perspective. And then both Anne and myself work in different areas in terms of the application of the SFDR. So I suppose effectively, we're going to just give some practical case studies and kind of ask each other practical questions about what does this mean in terms of implementing this in the real world. So hopefully there'll be some good insights there. So definitions time, when we talk about ESG, companies generally talk about sustainability. And when they do so, it's really that they're thinking about it across these three pillars of environmental, social, and economic, or people, profit, and planet. And that goes back to, the original Venn diagram for sustainability, which really has those three circles, people, profit, and planet. And something is sustainable when you kind of get the balance between those three pillars right in the middle. And I suppose the challenge is so far we've kind of very often sacrificed either the people piece or the planet piece in the pursuit of profit. And when we talk about sustainability now, it's really about trying to just get a better balance between those three pillars. It is not about forgetting about profit in completely. You can't have a sustainable business unless you are profitable. Really, when we think about sustainability, it is about going back to those three pillars. And then when corporates think about and develop their strategies, they're also thinking about those three pillars. So environmental, social, and economic. And I suppose if you look at those issues, the environmental, they're the ones we're all familiar with. It's carbon emissions, water usage, biodiversity loss, etc. The social issues are those ones that are relevant to the boundaries of the company. So if you think of the SDGs, there's big lofty goals in there: no hunger, no poverty. When corporates talk about sustainability, they don't necessarily go that far. Really what they're talking about is the social issues that are relevant to kind of the boundaries of their corporate, and also up and down the value chain as well sometimes. So they're thinking about human rights, labor rights, health and safety, responsible marketing. Of course, diversity and inclusion is a really big one there. And then from an economic perspective, remembering that, I suppose, traditionally, and this is now starting to change because it's all getting more integrated, but traditionally it was like you thought about your commercial side of your business and your kind of financial side, your profit side, separately to your sustainability issues. So let's assume that when corporates are thinking about sustainability, they were not really thinking about the profit side. The profit side is boxed off. So this is kind of the other things that they need to think about. So from an economic perspective, this pillar here it's really about the positive economic impact that a corporate can bring, whether it's, additional jobs, whether it's the tax they contribute to the national coffers, etc., etc. So I suppose in a lot of the frameworks, and I don't know if people are familiar with frameworks like the Global Reporting Initiative, Sustainable Accounting Standards Board, etc. This is kind of the thinking behind it in terms of developing what companies should be, I suppose, A, thinking about in their strategies, and then B, reporting on. It's these three pillars, and all wrapped under a framework of corporate governance. And I suppose the important thing is not all of these issues are relevant for every single company. If you're an airline company, you're going to be thinking about, carbon emissions. Obviously, you're also going to be thinking probably about diversity and inclusion in your workforce. There'll be other issues there that you're thinking about. If you're a food manufacturing company, it's very different. You're going to be thinking about sustainable packaging more so. You're going to be thinking about human rights in your supply chain, etc. So not all of these issues are relevant for every company, and they're generally relevant by sector. And it's up to every corporate to kind of figure out, okay, what are the material issues for me? And there's this real move towards double materiality, if people have heard of that. So it's not just about the impact of the company on people and planet, but also about the impact of these kind of changing world that we're in, these sustainability trends that we see, the impact of those on the company and the company's response to it. So corporates develop their sustainability strategies, and then this is where the ESG piece comes in. The ESG piece is the financial lens through which financial stakeholders, whether it's investors, lenders, or insurers, evaluate the corporate strategy and the performance on those key sustainability issues. And you can see here, the economic impact piece, again, your profit piece isn't assumed, right? These are the other issues to be thinking of. And again, you see the positive impact, economic impact piece has fallen away here, and it's being replaced by corporate governance, basically, in that your financial stakeholders are outside the legal entity, and they want to ensure as a baseline that the company has appropriate corporate governance to ensure things are being done right, basically. And what the financial lens, and ESG as a term is only around since 2004, but what that financial lens has brought is a real rigor to corporate sustainability efforts, because the financial sector wants consistent, comparable information and data on the financially material issues in order to basically compare apples with apples and decide, what are the important issues that they think are there for a company? How is that company performing on them relevant to other companies that they could invest in or lend to? So I really feel the ESG angle has brought a real rigor to corporate sustainability and the way corporates think about sustainability, and it's been a huge driver. of, I suppose, corporate responses and the growth and rise of corporate sustainability on the global agenda. So really, sustainability from a corporate perspective and ESG, they're just two sides of the same coin. And climate is absolutely at the core of ESG. You know, really, there was increasing evidence that ESG was relevant for financial performance. There's been a whole rake of studies that have come out since 2015. There is increasing evidence that, you know, when companies got environmental and social and governance issues wrong, that it was hitting, you know, share values, it was resulting in fines, etc. And you can look at Volkswagen or Facebook or any of these, you know, where these kind of environmental or social issues are like actually hitting the bottom line. But there was still, around climate, there was like a real challenge about getting the financial sector to engage on climate, and a real gap for someone to step up and to translate the narrative from existential risk and the polar bears and, you know, rising seas in faraway places into financial risk. And the man to do so was Mark Carney. I'd really recommend reading this speech, The Tragedy of the Horizons, in September 2015. It's still absolutely valid today and has driven a lot of where we are today in terms of ESG and climate. He did that speech just before the Paris Agreement was reached, and it's really a seminal speech in terms of engaging the financial sector on climate change, because he didn't mention the environment. He hardly mentioned people. What he looked at was the financial risks associated with climate change. And he was referring to this really, really detailed work that had been done by an organization called the Carbon Tracker Initiative, that had looked at the fossil fuel reserves on the balance sheets of listed oil and gas majors. And they'd crunched the numbers and basically said, listen, if we want to stay within 2 degrees temperature increase above pre-industrial levels, then we can only burn between 20 and 40% of the reserves, coal, oil and gas reserves of listed firms, never mind the unlisted that are maybe held by sovereigns. So that, of course, is a major risk for investors in those listed companies. And that was when we first started to hear the references to stranded assets, carbon bubble, unburnable carbon, all that. And he went further than just thinking of the fossil fuel majors, and he said, listen, climate change is going to impact every sector of the economy. And if it's too late and too sudden a transition to a low carbon economy, so if loads of changes come in, whether they're policy or reg changes or consumer or market behavior changes or physical changes, that could have dire implications for systemic financial risk, could cause the next financial crash. And so he really just focused on those financial aspects and really pivoted the narrative so that it just made sense, and it was very clear this is about financial stability risk. His view was that, you know, it wasn't downhearted at the end of that speech in any way. He was just saying, listen, you need more information. Companies need to, again, this point about consistent, comparable information on climate risks so the markets can measure and respond to those risks appropriately and can allocate their capital appropriately. And I love the phrase there, the right information, whether you're a skeptic or a believer, back your conviction with capital, and then let's see how we get on. So I suppose one thing I just want everyone to go away from this with as well is that ESG is just data. Of course, when I wrote that down, I went, oh, it's not just data, actually, it's also a list of issues. So it's like that big list of issues I showed you, but then it ends up just being data produced by companies on that list of issues that is used by the financial sector. The key point here is that, you know, there is no such thing as an ESG stock, an ESG company, an ESG economic activity. There is such thing as a climate aligned company, or a company that is aligned to, has set a transition pathway in line with the Paris, or a company that knocks the lights out on, you know, human rights due diligence, et cetera, et cetera. But these are all different issues. Companies, you know, think about them differently, perform on them differently. So there is no thing as an ESG economic activity. And furthermore, ESG investing is not one thing. It covers a really broad spectrum of investment practices. So if you kind of go back to the PRI definition, like a responsible investment, which, and people are kind of more often now referring to just as ESG investing, it's just a strategy and a practice to incorporate ESG factors, that ESG data that companies are producing, that the financial sector and investors incorporate that in investment decisions, and that they are then active owners of whatever they use. And the whole purpose of it, this is not ethical investing. The whole purpose of that is to manage risk and generate sustainable long-term returns. So very often there's this kind of spectrum of ESG investment approaches shown. So your traditional investing is on your left-hand side there. You know, we don't think ESG has anything to do with anything. We're going to just look at the financial statements. That's it. You know, let's ignore everything else, nothing else, this climate change stuff or backlash against, discrimination or whatever it is. That's nothing to do with this company and its financial results. It will never impact it. So we're just going to look at the financial statements. And then as you move across to the right, it's really you're integrating more and more ESG into your decisions. And these aren't all kind of standalone approaches. They kind of layer on top of each other very often. But negative screening is like that you just exclude certain stocks that you don't like. Positive screening could still mean that you invest across every single sector of the economy, but that you're picking the ones that perform best on a particular ESG rating system, whether that's your own in-house one or an external one. ESG integration is that you really sit down and think, okay, what are the most important ESG issues for this company, and how is it performing on it? It's really kind of an integrated, your ESG, it's another lens you apply over your financial analysis. Engagement is obvious. And then you're into sustainability themed investing, which is now basically defined under the SFDR, and impact investing, which continues to be slightly separate. It's kind of impact first, but it is still alongside a financial return. I always go to the Global Impact Investing Network for the definition of that. So on the left-hand side, ESG risks or impact don't matter. The right-hand side, fully oriented. Really, these ones are about the investment process, and these are about the outcome. It's about like, what is the ultimate impact of that? All investments have an impact, but what is the ultimate, really you're talking about a positive outcome on people or planet on the right-hand side there. And what's been happening is that all of this, you know, fund managers could just say, oh yeah, we're an ESG fund manager and we have these ESG funds or SRI funds or green funds or whatever. It was self-defined, and what was happening was a lot of greenwashing was starting to come in. And from a reporting perspective, from a disclosure perspective, it was completely voluntary, what you disclosed, when you disclosed it, you know, your in-house bespoke methodology. You said what you thought was ESG investing. You might reporting that to your investors. You might report, you might sign up to the PRI and reporting it annually. You might do a lovely glossy ESG report. And really what's happening now is we're moving from that, from voluntary, which is, you know, as described, to mandatory, which is SFDR is requiring disclosures. If you say you're doing something on the tin, you must disclose what it is. You must do so in your pre-contractual docs before you raise your money. And then annually you must report on progress. And then you have to do these website disclosures as well. And Anne's going to talk a bit more about that. And that is subject to financial regulatory review. So we're really moving from, this world is completely dramatically changing. And TCFD as well, which is the disclosure framework that came out after Mark Carney's speech, and he spearheaded it. That's actually effectively coming in by stealth through the financial regulator. If you look at what the Dear CEO letter on climate from the central bank last year, effectively what they're asking is, have you implemented the TCFD approach? And we're going to come in and look and see, have you? And really, this is, I'm sure everyone's hearing about greenwashing and tackling greenwashing claims. The financial regulators are coming after this, and you can absolutely see that. So the SFDR, what is it? It's just disclosure requirements. It is not mandating anyone to do anything. It is just mandating them to disclose what it is they are doing if they say they're doing something. It is about tackling greenwashing. It is to facilitate comparability of products, and it is subject to regulatory review. So if we go back to this diagram, this is your Article 6. These are your Article 8. So funds that promote environmental or social characteristics. And this is your Article 9, your dark green funds, as they call them, though it could be a social objective. So that's a bit of a misnomer. And really what we're saying is we're moving from the left-hand side, because you're not saying you're doing anything on ESG. So there's limited reporting requirements for your investees, limited disclosures required by the fund and the fund manager. Over to the right-hand side, you're saying you're doing loads. Therefore, tell us about it. Tell your investees and tell the fund managers. And with that, I will hand over to Anne.
Thanks, Laura. And I really like that really clear way of thinking about SFDR from an investment process perspective. It I think it really helps to feed in and make SFDR a reality rather than a legal text, which it is obviously, and that's what I'm going to talk about a little bit more. You'll all be really pleased to hear that I am not going to go into detail about what is in the legislation, because I think from the perspective of this audience tuning in, being a chartered accountant's webinar, I think the fund structuring is going to be done by a team of lawyers. Okay, so I guess just a quick reminder in terms of a legal legislative text, what are we dealing with here when we look at SFDR? So this is an EU regulation, which means it's directly effective. So it's enacted at EU level, it's directly effective in all member states. So in Ireland, so you don't need a local piece of legislation to implement it. So you're looking at the European text, okay? When we think about what kind of fund structure, what kind of vehicle are we going to be implementing all these strategies that Laura talked about, if you want to be in a position, or if you think you're in a position to disclose as an Article 9 fund. Okay, remember those Article 9 funds are the ones that are really maybe delivering the impact or really having sustainability themed strategies. So the types of entities in scope of SFDR when it comes to funds, so these are the entities, these are the financial institutions, are AIFMs, so alternative investment fund managers, and UCITS mancos. So when we're talking about regulated funds, they're the entities that we're talking about. Products are also covered in SFDR, so the actual fund vehicle. And when we're talking about that, we are talking about UCITS funds and AIFs, so alternative investment funds. So SFDR, its disclosure and transparency requirements hit at both levels. It hits at the entity level and it also hits at the product level. And there's lots of different types of legal structures. I know on Laura's slide there was talking about LPs, limited partnerships. So you can have different types of legal vehicles. You can have ICAV would be a traditional structure, would be you have an AIFM or a UCITS management company. And then underneath that, you actually have a fund vehicle. So an ICAV is a specific corporate vehicle set up for funds. So that would be quite a typical structure. So you can begin to see already the complexity and the layers of SFDR, where you have to think about disclosures at lots of level. And this is where the design of it as a legislative text starts getting quite clever. So SFDR, Laura's hammered this home, I'll say it again, it's a transparency regime, okay, it's a disclosure regime. So when you start sitting down in the legal process to set up an Article 9 fund, where does SFDR start to hit? Okay, where's the reality? So really where it starts to come in is when you are producing the templates. So these annexes that are specifically in SFDR, it's a prescribed structure. You need to work with them. You need to drop them into your prospectus or your supplement as is. Okay, you can't tinker with the content of those. And that's where the reality hits. So if you haven't, if people, on this webinar haven't already looked at these templates and they're thinking of Article 9 funds, I would say that is the place to start if you're looking at SFDR. And so it's the drafting exercise where the detail and the kind of practical points that we're going to talk about in a little while start to really become questions that you need to strategize and work through. So you're filing, so you need to disclose what you're saying in a specific template in your supplement. For a regulated fund, that will get filed with the regulator. So in Ireland, that's the Central Bank of Ireland. From a regulatory perspective, there's going to be questions at point of authorization. So right now we're in a deadline scenario where under SFDR, any fund that is existing at the moment, if it is saying, right, yes, I am a product that will disclose as Article 8 or Article 9, you need to file the template under the SFDR legislation as part of your prospectus with the central bank by the 1st of December this year, and that's with the view to complying with the SFDR deadline at the 1st of January. Okay, so that's the regulatory deadline that everyone is facing at the moment for existing funds. If you're setting up something new, it's going to be part of your product development process. So that's a bit about fund structuring. When we think about the legislation and the guidance, and so you have the legislation, that's your primary text. What else is out there to help you work through as you're structuring your Article 9 fund? There is guidance. So there's guidance from European supervisory authorities. ESMA in particular has come out with guidance, and also the European Commission has given some questions and answers in relation to specific points under the legislation. So there is guidance and help out there if you know where to look for it. It's a little bit piecemeal at the moment, so there is an element of navigating through that. There are other sources as well. So the platform on sustainable finance, as it is now, works with the EU taxonomy, and we'll come on to that now in a second. And has issued guidance, reports, papers. There is tons of work being done in this from a practical, from an academic, from a scientific and technical perspective. So there is lots of guidance out there. The trick is a little bit knowing how to work with it. So from a legal perspective, we can't talk about SFDR without talking about the EU Taxonomy Regulation. So the EU Taxonomy Regulation is another legislative text. It's another EU regulation, again, directly effective. So the EU taxonomy, I mean, Laura can probably touch on this a little bit later, but what is it? It is a classification tool to determine how economic activities can contribute to environmental objectives. Okay, so it's quite a technical piece of legislation. How does it interact with SFDR? Well, interestingly, SFDR doesn't mention the EU taxonomy at all. When you read the level 1 text, it actually doesn't mention it. But the EU taxonomy amends SFDR. How does it do that? Well, in a couple of ways, but again, it's around the disclosure and transparency. The taxonomy does an awful lot of things. Okay, it does an awful lot of things. When it comes to SFDR, really, there's three articles in there you need to be concerned about. And what they want you to do, if you are in Article 8, or for our purposes today, in Article 9 fund, they want you to disclose what how much your underlying investments are aligned with EU taxonomy disclosure. So that's a challenge not to be underestimated, and we'll talk about that a little bit more. But I just wanted to kind of clarify from a legal perspective how the two interact. Really important point to make about SFDR, we've said it's transparency, it is disclosure. It is not a product label, okay? I like to drive that point home, and the European regulators are always at pains to drive that point home. There is other work underway at European level to create product labels for retail financial products, an eco-label. That is not what SFDR does, okay? That's something completely separate. So along with that, there's no legal mechanism under SFDR to convert your fund. If you say, oh, I'm an Article 6 fund right now, I want to be an Article 8, there's no mechanism in there to convert, okay? It all comes back to the product. You need to look at what is your product doing right now, and then you decide, yes, it is appropriate for me to disclose as Article 8, Article 9, or Article 6. Okay, no legal mechanism in there. So you hear a lot of talk about converting from 6 to 8 and 8 to 9 and maybe 9 to 8 if you're not so sure. So no legal mechanism for that. Article 8 and Article 9, just a quick maybe point on the key difference between those two, and maybe on the next slide we might have just a couple of words on what that is. So at a really high level, the key differences between Article 8 and Article 9. Article 8, you are promoting environmental and or social characteristics. When you're an Article 9 fund, you have an environmental and or a social sustainable investment objective. So that's the piece upping the game really that Laura illustrated really well in her slide earlier about investment processes. Other key point for our conversation today is that an Article 8 fund can make sustainable investments, but it doesn't have to. When you're an Article 9 fund, all investments must be sustainable investments. So that is a really core difference. We'll get into that a little bit more. So sorry, if I could just go back to the previous slide there, thank you. Just a few other points I wanted to cover here is that when you're looking at an article, a fund that can disclose as Article 9, and particularly when you're looking at the disclosure templates, that can look quite different in practical terms depending on your asset class. And by that I mean if you have a real estate fund or a real asset fund, that can look quite different and throw up different issues than a listed equity fund or a fixed income fund. And Laura and I are going to talk a little bit more about the practical issues around that in a while. So definitely issues around the data. How do you measure what you're saying, what you're holding your fund out to do, what you're committing to in the template? So that can look quite different across asset classes. Other point is around passively managed versus actively managed funds. Again, there can be quite a difference in what you're disclosing when you're a passively managed fund versus actively managed funds. So when you think about active management a lot, you can see that the engagement piece, which is quite an important part of SFDR if you're thinking about encouraging good governance practices from investee companies, the engagement piece for active management really important there. Passive, you kind of think, well, is that more difficult to do? Now it is possible, but on the face of it, it looks a bit more different. So it can be distinctions there in what templates look like. Always want to mention about the website disclosures of SFDR. Laura highlighted them. You need to have those in place as well as your supplement, your pre-contractual document. And actually those website disclosures aren't a cut and paste of what's in your template. They're quite different. Some of it's the same, but there are different elements. And those different elements can be around how you're monitoring the environmental and social characteristics throughout the life cycle of the product. So, you know, it's easy to say, yeah, here's my objective, here's how I'm monitoring it, but you need to say how you're doing that through the life cycle of the product and any control mechanisms you have around that as well. There's also different disclosure on the website around data sources and processing. So used to attain your environmental and social characteristics or objective. So I wouldn't leave the website disclosure to one side when you're looking at the template. I would look at it at the same time. So we've already talked about, yeah, thanks, what Article 8 and Article 9 are for. Just a few, I suppose, issues that I find when you're working through the disclosure process that come up time and again as points that tend to need a lot of collaboration around figuring out what are we saying, how can we back it up when we do commit to putting it in our template. So EU taxonomy alignment, I've written down there as the first one. So when you're a fund and you're disclosing as an Article 9 product with an environmental objective. So the taxonomy is about environmental objectives. Right now, it doesn't cover social objectives. There is a plan for that. Right now, it's environmental objectives. You need to disclose in your fund documentation your percentage alignment with the EU taxonomy. So everything that goes with the EU taxonomy needs to get distilled down into one percentage figure. Okay, and that is a tricky and challenging thing to do. And you need to disclose that alignment by revenue, by CapEx or OpEx. Okay, so there's a whole mechanism behind how that gets calculated. So as I said, tricky process, not least because all economic activities are not yet covered by the EU taxonomy. So sometimes you don't have the option to do that. But having said that, the taxonomy alignment can be zero. It can be. And I think it'll be interesting actually on the 1st of January next year when we get a flood of templates on the market to see how many taxonomy alignment figures are actually zero. Sustainable investment is another really critical concept for Article 9 funds. So I've already said that if you're disclosing as Article 9, every single asset that you're investing in, broadly speaking, needs to be a sustainable investment. That has a specific definition in the legislation. How does that interact with taxonomy alignment? So if a sustainable investment, a subset of being a sustainable investment is being EU taxonomy aligned. So using the EU taxonomy, if your economic activity is covered in it, is one way of saying you're a sustainable investment. It's not the only way. It is a broader definition. If you're not using the EU taxonomy to evidence that what you're investing in as an Article 9 disclosure is a sustainable investment, you need a really solid framework to establish this, which works through every single element of that definition. And I think Laura actually has a really nice slide on this after this slide sort of sets out the difference between those. So we can take a look at that in a minute. A catch with sustainable investments: if you're using taxonomy alignment to say you're a sustainable investment, you need to double up on your do no significant harm analysis. There's a process for establishing do no significant harm under the EU taxonomy, but for the purposes of SFDR, it requires you to do that in under SFDR requirements as well. So that's a catch, I think, that that you need to be aware of, depending on the categories of the fund that you're investing in. So another talking point that comes up when you're working through the legal process is principal adverse impact indicators. What are they? They are, I guess this is the sort of the kind of name and shame part of SFDR, really, because you can have your investment process, you can have your theme about what you're investing if it's a thematic fund, but part of SFDR, and it requires you in certain ways, or you can opt into it. But what you also need to say is, well, I'm promoting certain characteristics, or I'm delivering on my sustainable investment objective, but I'm also assessing through a specific list, and this is all listed in SFDR under certain headings. For example, emissions is one heading, or waste is another heading, that my investments aren't falling foul of certain thresholds, so that they are actually, there's nothing in my portfolio that's hindering achieving my sustainable investment objective. And the mechanism whereby they do that is through the principal adverse impact assessment. So there's several uses for principal adverse impact. The main way you hear about it is that there is a requirement for financial market participants. So these are the ones we talked about, the UCITS ManCos and the AFUNs, to publish and maintain on their website, so website disclosure here, not pre-contractual, where they consider principal adverse impacts of investment decisions on sustainability factors. There is a template, again, another template in SFDR for that, where you need to work through all the indicators and publish your statement. You don't have to do that. You can opt out of doing that unless you're a large entity that's caught. We won't go into the detail on that. Interestingly, for Article 9 funds, ESMA has said that in supervisory guidance that went out to the supervisors, so from an Irish perspective, the central bank, that it would expect funds disclosing as Article 9 to publish this statement. So I think that was an interesting supervisory comment. I think we'll see how that works in practice. You can also disclose principal adverse impact at product level. So again, when you're structuring your product, there can be questions around how we do that. What does that mean? And as I've said already, for a sustainable investment framework, you must consider principal adverse impacts in the do no significant harm element of a sustainable investment analysis. You could also use them as a sustainability indicator, which I see more and more people looking at that actually from a disclosure perspective. So last 2 points there: sustainable investment objective. Don't need to go into that in too much detail. This is, as if you're disclosing an article fund, you need to say, what is my objective? What am I doing? Do I have a social objective? Am I trying to improve access to housing? Is a good social objective, and lots obviously of environmental objectives. Really critical with that is, if you state your objective, you need to have an indicator saying, which will show how that's being attained, and you need to be able to measure that. So your indicator needs to be something that's measurable. That can be quite tricky. Final point there then, ongoing governance, oversight and reporting. So once the fund is set up, how do you ensure on an ongoing basis that it satisfies all these SFDR requirements? And that can be quite a layered process in a fund structure, because a typical fund structure, as I described at the start, you have your fund, you've got a management company, you typically would delegate the portfolio management piece to a portfolio manager. So between all those entities, how do you ensure through the delegated structure that the governance and oversight, so say the board of directors of the fund or the ManCo, are able to discharge their regulatory requirements, including in relation to sustainability disclosures. How does that get done? Does that get done through reporting from the portfolio manager? So there's always lots of reporting in a fund structure to discharge governance and oversight requirements. Do you need to look at more reporting in relation to SFDR in particular, principal adverse impact reporting? So lots of questions around how you can reassure your management company that the fund is being operated and governed on a continual basis. And other fund service providers will also have questions around this. So your depository, for example, will also have questions as well. Fund directors are also going to question and challenge all these issues. So there really is a whole ecosystem of service providers in a fund structure that will have their own need to have their own knowledge base and skills around SFDR and taxonomy in order to be able to challenge this properly, to make sure that it's being governed continuously in alignment with its sustainable investment objective. So that, I think, is all I'm going to say on this slide. If there's questions, happy to take them at the end. But I guess what we wanted to do now, between Laura and myself, is maybe get into some practical examples. And so I always enjoy asking Laura this question, because she's so knowledgeable about it and has just done so much thinking about it. So what I'd like to kind of air here in the webinar is Laura, when you look to apply SFDR requirements and the detailed requirements in the context of a real estate fund, what kind of issues, what are some of the practical issues that you need to address when you're working through that process?
And actually, just before you answer that question, Laura, if I may, I'm encouraging people to send in questions, but it's quite clear, and what's coming through indeed from the two excellent presentations we've seen and from the questions that are coming through our Q&A panel, is that the regulation obviously presents many questions for finance professionals, because I know the questions that we're getting are quite specific, and in some instances I think that our speakers might require more information to be able to respond. So you may have seen that in some of the Q&A responses. So I just wanted to make that clear, and now I'll leave you to respond as you will, Laura.
Great, thanks a million. So yeah, I guess we just said we kind of use this to kind of walk through. I do a good bit of work with real asset funds, whether it's private equity or real estate or renewable energy. So I suppose just to give an example of Article 9, an Article 9 real estate fund and what that actually looks like. So I suppose one of the points, and Anne said it already, is like, at this point, there is no conversion from, Article 6 to Article 8 or Article 9. Like it comes down to what is your investment strategy and particularly with Article 9, you need to just, at the outset, is your investment strategy for this particular fund as a fund manager, is it a sustainability themed or an impact investment strategy? If so, then you disclose under Article 9 because you're kind of in that world. If you're talking about ESG in any way in relation to what you do in your investment process, whether it's that you integrate, whether it's positive screening, whatever it is, then you're in Article 8. So you pick out that, the way, but yeah, that point about kind of conversion, because it's myself and Anna are on the same page on this. Like it comes down to what, like, you're the fund manager. How do you think about ESG? How's this fund set up? So I suppose I'm going to look at an Article 9 real estate fund, but very much like you basically have to have decided that you want to be basically a green real estate fund from the outset in order to fall into Article 9 and disclose under Article 9. So basically, what I just want to show here is that Article 9, what you have to disclose under in order to be in Article 9 and be able to disclose under Article 9, it has to be a sustainable investment, and that means it should be in an economic activity that A, contributes to environmental objective or social objective, B, does no significant harm to any of those objectives, and C, the investee companies follow good governance practice. And I just stacked up the EU Taxonomy definition underneath, because you can see there, it's a slightly different angle. It's about the economic activity, and it says that is environmentally sustainable, where A, it contributes substantially to one or more of the environmental objectives, does not significantly harm any of the other environmental objectives, and is carried out with the compliance with the minimum safeguards. And you can nearly tack through. So as Anne said, you know, an Article 9 fund, the assets don't have to be aligned with the EU taxonomy. They may not even be defined in the EU taxonomy, because obviously the EU taxonomy only defines certain economic activities. But you can see increasingly, if it is an asset, you know, an economic activity that is defined in the EU taxonomy, like green buildings. If you say, yeah, I'm an Article 9 green real estate fund, but 0% of my buildings are aligned to the EU taxonomy, you can see how that type of a disclosure would make investors go, well, why do you think why do you think these are green buildings? You know, and they're just going to look at you more carefully, and it might be totally valid. But, you know, you can see how these disclosures will just trigger additional questions and additional discussion with investors. So I suppose what I'm trying to say is, so you can be an Article 9 fund, even if none of your assets are EU taxonomy lined. But that is kind of the gold standard. And that's really, you know, if you look at the EU taxonomy definition, as Anne said, it's technical, but it's scientific language. There's no financial language in the EU taxonomy. It is literally, you are a green building if you meet XYZ in terms of these environmental criteria, and then, you know, you do your bit on kind of the social and governance piece under the minimum safeguards. So, and the same, whether it's a cement company, whether it's whatever the economic activity here is. So kind of that's if you're looking at an Article 9 real estate fund, then that's kind of, if your assets are aligned with the EU taxonomy, then you're absolutely in a good place, good to go. If you want to be, if your assets don't meet, they aren't as good as that, they can still meet the definition of sustainable investment, as Anne said. But then your question is, well, what does that mean? So they don't have to be as good as the EU taxonomy, but how good do they need to be then to be green? In the case of the EU taxonomy, the core criteria for a building is around its BER rating. So basically the energy efficiency of the building being developed. So from an EU taxonomy perspective, the requirement is that you have to be 10% better than the current energy efficiency requirements under national building regulations. And again, you can see here what the EU are trying to do with the taxonomy. They're trying to push industry beyond what the politicians are currently brave enough to put into building regs, by saying, okay, you build to building regs nationally, that's fantastic, you're great, but if you want to be EU taxonomy aligned, you have to do better than that. So basically they say, okay, you have to be 10% better than national energy efficiency requirements to be EU taxonomy aligned. That's the really core criteria under to be a green building. There's some other bits like for large buildings, etc. But then if you go back, so if you start there and you kind of go back and say, okay, well, what from a sustainable investment definition under Article 9, what do I need to be? You know, it's the same stuff. You don't need to be a fossil fuel related, you can't be a fossil fuel related building, but what level of energy efficiency is good enough? And you need to think this through for any kind of particular sector or economic activity you're looking at. Helpfully, and this isn't always the case, in the SFDR itself, there is some help on what a good enough green building is. And that's basically that you've been built in line with national NZEB, which is National Zero Energy, net zero, near zero energy building. So the energy efficiency requirements around that. So there is some guidance in there. So, but you can see that you can have an Article 9 fund, real estate fund, and its assets, the core criteria is that all the buildings in there are built in line with NZEB. But if you want them to be EU taxonomy aligned, you have to go better than that. And in a real estate context, and a question came in on this already, in a real estate context, ESMA has already come out and stated you can't have a brown to green fund. All of the assets in there need to be sustainable from the outset. So if you're a brown to green fund, if you're a fund manager that says, I'm going to buy all these older buildings, I'm going to upgrade them to, you know, have an amazing EPC or BER rating, that's fine. Disclose as an Article 8 for the period while you're renovating them. And then once you have them done, then you disclose under Article 9. And the whole point is to find the investors that want to kind of go on that journey with you and kind of believe in that journey. But so really importantly, from a real estate fund perspective, it's not about the in-use phase of the buildings, the actual operations of the buildings. So you do have to disclose that annually under the PAI requirements, nor is it yet around embodied carbon. But the EU taxonomy is going to develop. So the EU taxonomy on new buildings, basically that's your primary one, the climate mitigation. Are you making a substantial contribution to climate mitigation? Yes, you are, if you are meeting that 10% better than NZEB. Then you have to make sure you're not doing any significant harm to the other environmental objectives. There are 5 other environmental objectives, and that sounds really onerous. Oh, I can't do any significant harm to water or to biodiversity. There are really, really specific things in the EU taxonomy, really, really specific boxes you have to check on each of these points. So it's like you have to use, really water, resource efficient water appliances in the building. Yeah, you can't build in a forest or land of high arable value. The way it's really specific things that you have to do. Actually, and then meeting the minimum safeguards, it's not just about having a policy around kind of being good on S&G, it's actually having the procedures in place. And then there is a distinction between that, and then this is kind of the minimum requirement under Article 9. As I said, it's a lesser requirement from a climate mitigation perspective, but similarly for the other environmental objectives, it's probably more likely to be just compliance with national law. And then you do also need, and Anne referred to this as well, you need to kind of manage your S&G as well. And that actually refers back to the requirements under the minimum safeguards, and there's a whole report about that. But then so just to give people a feel for a real estate fund that wants to be, that is an Article 9 real estate fund, how it qualifies. But so I'm just going to turn that question back to Anne. Obviously, there are very different considerations for listed equities funds. I love the real asset space because, it's just so real, the way clues in the name. But in listed equities, what are the different practical considerations that you need to be thinking about?
Actually,
Susan, did you want to say something there?
Yeah. A couple of things I wanted to, I think you may have answered this question, Laura, that came in, which was, what does substantial contribution look like? And I think that's maybe been addressed.
It's literally defined in the EU taxonomy. So yeah.
Another question, I just wanted to put this out there because I know we've only got 7 minutes left. Question was, you referred to templates, Anne, I think, and is there a location where these templates are available?
Yeah, there is. So they are in the legislative text. So if you go on, if you can Google it, the Sustainable Finance Disclosures Regulation. So there are 2 levels of legislation. You've got the core regulation. You've also got secondary legislation called level 2 legislation, which some of you will probably have heard called the regulatory technical standards. That's what they are. The annexes are in that. All the annexes, there's 5 of them actually. So the principal adverse impact reporting template, and then the pre-contractual disclosure templates, then the periodic disclosure templates are all in there. ESMA separately has issued fillable templates. So you can actually take them and use them. So that was, obviously I don't get out enough. It was a good day for me when those fillable templates were released. But again, they're available on the ESMA website. Yeah.
Excellent, thank you. And there was another question that came in, but it's quite broad. It was, are there new regulations under SFDR coming into effect on the 1st of January 2023, and what additional requirements will these impose? To me, that sounds quite a large question, and maybe it's kind of all part of what we were talking about today. So maybe
I mean yes, that's a good answer. A lot of everything what we talked about today will go into what needs to be disclosed under SFDR on the 1st of January deadline. Yeah.
We have 5 minutes, and Laura, you mentioned you wanted to put a question back to Anne there. Yep. If time permits, with the 5 minutes that are there, would that be possible?
Yeah, I think that'd be great, because listed equities are just so different. So I'll hand over to Anne.
They are, and I mean, I won't take long, because we have 5 minutes, and if you want to squeeze another question in, but I do, because I mean, as Laura said, so the real asset, I mean, you can walk past them, right? You can walk past a building being constructed, you can see it, it's tangible. When it comes to listed equities, so take, for example, maybe just a large cap fund, so you're investing in large corporate entities. I think it's less tangible for a start, but the other point that always strikes me is that when you need to think about sustainable investments or being EU taxonomy aligned, you're looking at the economic activity being carried out. If you're building a building, that's the economic activity, but in a company, there could be several economic activities happening. Or I mean, even if it is say it's a steel manufacturing company and it has 3 plants, one of those manufacturing plants could be taxonomy aligned. Okay, it could be new, it could be established to be taxonomy aligned, and the other 2 mightn't be. So the company the steel manufacturing company, you need to break down its economic activities into its constituent parts. So that for me is I suppose it is, a challenge in a way about how you're trying to figure out if I'm a sustainable investment. A lot that I think comes up for listed equities in a way that it wouldn't necessarily for a real estate asset. And I think then when you're working through all the steps that we talked about, so you've got the sustainable investment objective, you've got the do no significant harm piece, and then the minimum safeguards. Again, for a company, it's a completely different exercise. You need to get different data. And I guess for listed equities, what you see a lot happening is the use of ESG rating agencies. Now, we're not going to go into that today because that's, you could talk about that, a whole different topic. But again, so these rating agencies are playing a valuable role, and they certainly put good value on the services that they offer, in terms of trying to quantify and measure and come up with these indicators around how you are delivering on your sustainable investment objective. So I think for listed equities, I sort of wonder, is it for a listed equity fund that wants to disclose as Article 9, to me, I think if it's a fund that has a theme, and so by a theme, I mean a fund that might have, say, it invests in renewable energy companies, might that lend itself more to being able to disclose as Article 9, perhaps than a general global large cap equity fund, which doesn't have that theme, and you're sort of, you need to, figuring out what the investment objective is, can be a little bit more challenging. So really very different as you work through everything that's technical, because as Laura and I both said, SFDR, EU Taxonomy, such technical pieces of legislation, all starts with the product. You need to figure out what your product is doing, what your asset class is, and then work through it. So the disclosures can look quite different, I would say, from a real estate Article 9 perspective than a listed equity perspective.
I have, there's 2 minutes to go, so I thought I might put one final question, which may or may not be a yes or no answer. It is, and I'm just selecting this because I thought maybe there would be a possibility for brief answer, and that's not to disrespect the other questions that have come in, and apologies if you can't get to them all. It is, if a fund sits under Article 6 but is being wound down, do the rules for disclosure still apply?
Yeah, so that's, I can talk about that, Laura. So there is some guidance out there in relation to structures that they're not actively marketing anymore, or they're being wound down. It comes up a lot for say, insurance products. So I think, and not giving legal advice here, obviously, depending on the circumstances, if it's not being actively offered, you may not need to comply with the disclosures, but I would want to go and look at the guidance and look at the specific situation of that fund to make sure that that's the case. But it is a possibility, and it has been addressed in guidance to date.
Thank you very much. And finally, this is not a question that came in, but it was a lovely remark just saying thank you for such a great session. And I would like to echo that. Thank you very much, both Anne and Laura, for these presentations. And to everybody who attended this morning's webinar and who contributed to the discussion via the chat function and the Q&A. To reiterate, this webinar will be available via the Climate Finance Ireland website and in the resources section of the Sustainability Hub of Chartered Accountants Ireland, along with all of our free resources on sustainability for accountants and finance professionals. Final thanks to Chris Donoghue, our AMV facilitator, who also has put a link in the chat to that certificate in sustainability strategy, risk and reporting that I mentioned earlier at the beginning. And thank you to the team at Climate Finance Week Ireland. I hope everyone has a lovely day and weekend, and goodbye for now.